So, good day everyone. We're going to discuss the chapter 5, which is Accounting and Finance Inventory in Quick Food Service Operation. First is, what is inventory accounting? So, based on our module, inventory accounting is the body of accounting that deals with valuing and accounting for changes in inventoried assets. So, a company inventory typically involves goods in three stages of production, which is the raw goods, in-progress goods, and finished goods that are ready for the sale. So, yung inventory account will assign values to the items in which of these three process and record them as a company assets. So, yung assets naman are good that will likely be a future value to the company. So, they need to be accurately valued in order for the company to have a precise valuations.
Inventory according date times the specific value of states at creating stages in their development and production. This according method ensure an accurate replication of value or of all assets company-wide. Carefully examination by a company of the values called increased inventory times and meters, production stages, and change and value changes in value and or of a number of reasons, including depreciation, deterioration, obligation, changes in customer taste, increased demand, deferred market supply, and so on. An according inventory according system will keep track of their change inventory goods of all their production stage and adjust company state values and the cost of assessed with the inventory according.
How inventory accounting works? Inventory accounting works by tracking inventory costs and recording inventory assets and the overall value of inventory at the beginning and the end of accounting period to determine the matrix of a business. GAAP requires that inventory is stated at replacement cost if there is a difference between the market value and the replacement value, but upper and lower boundaries apply.
What is inventory valuation and why is it important? Inventory management is important to small businesses because it helps them prevent stockouts, manage multiple locations, and ensure accurate record keeping, and inventory solutions makes these processes easier than trying to do them all manually.
What are the objectives of inventory valuation? Inventory refers to the goods made for sale or unsold goods. In manufacturing, it includes raw materials, semi-finished, and finished goods. Ang inventory valuation sa isang business ay ginagawa kada month para makita o malaman kung anong mga naibenta at hindi. Kabilang dito ang mga lahat ng produkto dahil sa isang business kasama talaga ang pagbibilang ng mga stocks. Dahil mahalaga ito dahil kapag kulang o hindi parehas sa stocks sa unang bilang ay pwedeng makasira ito sa business natin.
Determine the gross income. Inventory is used to find the gross profit, which is the excess of sales over cost of goods sold. To determine the gross profit or the trading profit, the cost of goods sold is matched with the revenue of the accounting period. Ang inventaryo daw ay ginagamit upang mahanap ang kabuuang kita na kung saan ay ang labis ng mga benta sa halaga ng mga kalakal na nabili. Upang matukoy daw ang kabuuang kita o kita sa pangangalakal, ang halaga ng mga kalakal ay itutugma ang naibenta sa kita ng panahon ng accounting.
Ascertain the financial position essentially means to determine or evaluate the financial status. This involves analyzing various financial statements reports, and other relevant information to gain an understanding of assets, liabilities, equity, revenue, and expenses. By examining these factors and performing various financial analysis such as ratio analysis, trend analysis, and benchmarking against industry standards, stakeholders can assess the financial strength, performance, and stability of the entity. This information is crucial for making informed decisions, including investment decisions, lending decisions, strategic planning, and assessing the entity's ability to meet its financial obligation.
How inventory is valued. The inventory of entity is an important current asset that requires accurate valuation so that the stakeholders get a clear picture of financial condition. Through this process, the entity gets information about the products like sales, closing stock, demand, cost, etc., which are important for future planning and forecasting. There are 4 accepted methods of inventory valuation. First is FIFO, stands for first in, first out. It is method used for cost flow assumption purposes in the cost of goods sold calculation. The FIFO method assumes that the oldest products in the company's inventories have been sold first. The cost paid for those oldest products are used in the calculation. LIFO stands for last in, first out. It is method used for cost flow assumption purposes in the cost of goods sold calculation. The LIFO method assumes that the most recent products added to company inventory have been sold first. The cost paid for those recent products are the ones used in the calculations. Why would you use LIFO? Weight average cost meaning. A high weight average cost of capital or WACC is typically a signal of higher risk associated with firms' operations. Investors tend to require an additional return to neutralize the additional risk. A company's WACC can be used to estimate the expected cost for all its financing.
And now we will talk about first in, first out or FIFO. This method is based on the premises that the first inventory purchase is the first to be sold, meaning first in, first out is commonly known as FIFO, is an asset management and evaluation method in which assets produced and are cured first sold to be used or dissolved of first.
Inventory valuation method is best. Choosing the right inventory valuation method is important as it has a direct impact on the business profit margin. Your choice can lead to the drastic differences in the cost of goods sold, net income, and ending inventory. There are advantages and disadvantages of each method. For example, the LIFO method will give you the lowest point because the less inventory items bought are usually the most expensive, while the FIFO will give you the highest profit as the first items in stock are usually the cheapest. FIFO is the most logical choice since companies typically use their oldest inventory first in the production of their goods. Deciding between these two inventory methods as the implications on a company's financial statements, as this decision impacts the value of inventory costs of goods sold and net profit. FIFO is one of the most common inventory management techniques used in manufacturing. This system helps ensure that the oldest products are used first and reduces the chance of spoilage or obsolescence.
To assess the method which is best for you, you need to pay attention to change in the inventory costs. If the inventory costs are escalating or are likely to increase, LIFO costing may be better as higher cost items are considered sold. It results in higher costs and lower profits. Ang pagkakaintindi ko po doon is, kung tumataas po yung pag-inventory natin, o tumataas po talaga, ang mas maganda daw po natin gamitin na costing is yung LIFO dahil much better daw po yun. Habang yung mga item po na matataas po yung halaga, nagre-result na po itong mataas po yung gastos natin tapos mababa po yung kita. Second that, in case your inventory costs are failing, FIFO might be the best option for you. Ang ibig sabihin po nun, kung sakaling bumaba po yung gastos po sa pag-inventory nyo po, ang maaari nyo pong gawin is yung FIFO. Dahil ang ibig sabihin po ng FIFO is first in, first out. Di ba, uunahin po yung unang may expired bago po yung dumating na deliveries. Example lang po. Third that, for a more accurate cost, use the FIFO method of inventory valuation as it assumes that older items that are less costly are the ones sold first. Para po mas maayos o tama yung gastos natin, lagi po natin gamitin yung FIFO. Kasi dito po, nababase po yung paglabas natin ng product, kung luma ba o bago.
As a business owner, you need to analyze each method and apply the method that reflects the periodic income accurately and suit your specific business situation. The Financial Accounting Standards Board, or FASB, in its generally accepted accounting procedures, allows both FIFO and LIFO accounting. For example, the FASB is to establish and improve standard of financial accounting and reporting that foster financial reporting by non-governmental entities that provides decision useful information to investor and other users of financial reports. It is important to note business cannot switch from one method of inventory valuation to another. If your business decided to change to LIFO accounting from FIFO accounting, you must file from 970 with the IRS. For example, the LIFO and FIFO, you can apply switch accounting methods, but you have to get permission from IRS and may have to go back and restate all capital gains that were calculated using the previous method.
These basic inventory accounting activity are expounded upon in the following bullet points. Ang mga pagkakasunod na bullet points ay mga karagdagang detalye tungkol sa mga basic inventory accounting activities. Determine ending unit counts. A company may use either a periodic or perpetual inventory system to maintain its inventory records. A periodic system rely upon a physical counts to determine the ending inventory balance, while a perpetual system use constant updates of the inventory records to arrive to at the same goal. Determine ending unit count. A company ay pwedeng gumamit ng periodic o perpetual inventory system para ma-maintain ang mga inventory record na may periodic system at nakarely sa physical counts. Improve record accuracy. If a company use the perpetual inventory system to arrive at ending inventory balances, the accuracy of the transaction is of paramount. Improve record accuracy kung ang company ay gumagamit ng perpetual inventory system para sa ending inventory balances. Mahalaga ang accuracy na transaction para dito. Conduct physical counts. If a company used the periodic inventory system to create ending inventory balances, the physical counts must be conducted currently. This involves the completion of a specific series of activities to improve the odds of counting all inventory items. Conduct physical counts. Ang company na gumagamit ng periodic inventory system ay dapat conduct o nagsasagawa ng current physical count sa pamamagitan ng particular na activity para mapataas ang bilang ng mga inventory items. Estimate ending inventory. There will be situations where it's not possible to conduct a physical count to arrive at the ending inventory balance. If so, the gross profit method or the retail inventory method can be used to derive a approximate ending balance. Estimate ending inventory. Sa sitwasyon na kung hindi available ang physical counting, ang kabuuang kita o mga pamamaraan na retail o inventory ay maaaring gamitin upang ma-estimate ang panghuling inventory balance.
Hello, my name is Frank Angelo Nicolas. This is my report. Assign cost to inventory. The main rules of the accountant on a monthly basis is assigning cost to ending inventory unit cost. The basic concept of the cost layering, which involves tracking tranches of inventory cost, involves the first in first out FIFO layering system and the last in first out LIFO system. Different approach is the assign of a standard cost of each inventory item rather than a historical cost. Explanation of assigning cost. The accountant main monthly rules involves assigning cost to inventory unit cost layering system like FIFO and LIFO. They can also use assigning a standard cost to each inventory. Allocate inventory to overhead. The typically production facility has large amount of overhead costs which must be allocated to the unit produce a reporting period. This is my explanation. The typically production facility must allocate a significant portion of this overhead cost to the unit produced within a report period. The representing bullet points cover the essential accounting for the value of inventory. In addition, it may be necessary to write down the inventory values for absolute inventory or for spoilage or scrap, or because the market value of same goods have declined below their cost. There may also be issue with assigning costs to join and by produced inventory items. We item upon these additional accounting activities in the following bullet points. This is my explanation. These bullet points discuss essential inventory accounting, including absolute inventory, spoilage, scrap, and declining market value of goods. Additional accounting activities are discussed in subsequent bullet points. Write down absolute inventory. There must be a system in place for identifying absolute inventory and write down its associated cost. This is my explanation. A system should be established to identify and record absolute inventory along with its associated cost.
The view level of cost or market. The accounting standards mandate that the carrying amount of inventory items be written down to their market values. If those market values decline below cost, account for spoilage, rework, and scrap. In any manufacturing operation, there will inevitably be certain amounts of inventory spoilage, as well as items that must be scrapped or reworked. There is different accounting for normal and abnormal spoilage. The sale of spoiled goods, rework, scrap, and related topics account for joint products and byproducts some production. Processes have split-off points at which multiple products are created. The accountant must decide upon a standard method for assigning product cost in these situations.
In
inventory as an asset. Your balance sheet lists inventory as an asset because you spend money on it and it has value. Inventory is defined as anything that you will incorporate for future use in your business operation. This definition covers items you have bought for resale, such as pants and shirt for a clothing store.
Finding the sweet spot. Finding the balance between having enough inventory to meet demand and avoiding excess is crucial for efficient operation. Lean inventory management beyond by Toyota emphasizes minimizing waste and maximizing efficiency by maintaining only the necessary amount of inventory. By developing strong relationships with suppliers and optimizing ordering process, businesses can reduce the risks of stockouts while minimizing carrying costs associated by excess inventory. It's a delicate balancing act that requires practice and attention to detail, but ultimately leads to cost savings and improved operational efficiency.
If a business is using FIFO, they technically have to pay more in income tax since there is a larger difference between cost and profit than as could be with the LIFO method. A business must also exercise caution while using the FIFO approach is to avoid overstating profits. This can occur when a product costs grow and the later value are utilized in the cost of good calculation rather than real costs.
In the United States, a business has a choice using either the FIFO, first in, first out method, or LIFO, last in, last out method. When calculating its cost of goods sold, both are legal, although the LIFO method is often frowned upon because bookkeeping is far more complex and method is easy to manipulate. Now, FIFO or LIFO. FIFO, known as first in, first out, an asset management and evaluation method in which assets produced or acquired first are sold, used, or sold first, while LIFO is accounting method assumes that sellable assets such as inventory, raw materials, or component most recently first. Both are legal, but LIFO is mahirap kasi nasa bookkeeping siya to process, recording company's financial transaction, to organize account and daily basis. 2. Corporate taxes are cheaper for company under the LIFO method because LIFO allows business to use its most recent product cost first. Typically, these costs have risen over time. Reduced profit may mean tax break. However, it may also company less attract to investor. Now, LIFO is not a good indicator of ending inventory value because it may understate the value of inventory. LIFO results in lower net income and taxes because of COGC, cost of goods sold, is higher. However, there are fewer inventory write-down under LIFO during inflation. A cost of the most recent product purchased or produced are the first to expense and also company slow to achieve investor expectation.
Why would you use FIFO over LIFO? FIFO and LIFO are both accepted methods for inventory valuation in the United States, but LIFO often viewed unfavorably due to complexity and susceptibility manipulation. FIFO, on the other hand, is simpler and more intuitive, making the preferred choice for businesses. LIFO's ability to use higher rates and costs first can reduce taxable income, leading to lower taxes. However, it can also understate profits, potentially making the company appear less profitable and investors. This trade-off between tax advantage and investor appeal is an important consideration for companies choosing between FIFO and LIFO. Under LIFO, the value of remaining inventory is based on older, lower cost items which may not reflect current market prices accurately. This can result understating the true value of inventory on the balance sheet, particularly if prices have been rising over time. Discrepancy between reported inventory values and the actual market values is another factor companies that must consider when selecting an inventory valuation method.
Hi, my name is Gabi Aranza Mendez and this is my part. The value of remaining inventory, assuming it is not perishable, is also understated with the LIFO method because the business is going by the older cost to acquire or manufacture that product. That older inventory may, in fact, stay on the books forever. Investors and banking institutions value FIFO because it is a transparent method of calculating cost of goods sold. It is also easier for management when it comes to bookkeeping because of its simplicity. It also means the company will be able to declare more profit, making the business attractive to potential investors. Lastly, a more accurate figure can be assigned to remaining inventory. Knowing when to use FIFO versus LIFO. In terms of investing in accounting inventory, FIFO is usually a better method for inventory when prices are rising, and LIFO accounting is better when prices fall because more expensive products are sold first. FIFO means first in, first out, and is a method used in inventory management to ensure that the first items entering an inventory are the first ones to leave when it comes time for shipping or sale. This helps to prevent wasting resources on old products and ensures that customers receive the freshest stock possible. FIFO focuses on using up old stock first, whilst LIFO uses the newest stock available. LIFO helps keep tax payments down, but FIFO is much less complicated and easier to work with.
So, bakit nga ba binavalue ng investors and banking institutions yung FIFO? So, it says here that it has a transparent method of calculating cost of goods and sold. So, ibig sabihin ng transparent method, mas madali na method then dun pa lang sa method na yun is wala siyang tinatagong mga bias or secrets sa way of calculating ng cost of goods nila. So, it's also said that mas madali siyang gamitin in calculating cost of goods dahil sa simplicity nito. So, ibig sabihin, pag simplicity sa madaling paraan ng pag-compute. So, then next, outside the United States, many countries such as Canada, India, and Russia are required to follow the rules set down by the IFRS, International Financial Report Standards Foundation. Ibig sabihin dito, yung mga countries na daw yun, mas prefer nila gamitin yung FIFO na pag-calculate ng bankings nila or mga cost of goods nila kasi yun nga, bukod sa madali lang siya gamitin, transparent yung method niya like nung sinabi ko nung